Perfect.
Real bad.
Okay, and you have the presentation in front of you guys. There's just a little bit of a clerical breakdown. I call this soup to nuts, which is an old term that means start to finish. It's kind of like how restaurants used to give you soup first and nuts at the end. Nuts and bolts is a very similar way, but basically the whole goal of this presentation is to just give you guys a really quick but decent understanding of how I work start to finish with my loan process. When you refer clients to me, what you can expect and what to expect, just even for when you're doing deals on the listing side and you want to know the process itself so that you can speak educated to a loan officer or a buyer's agent and say, hey, where are we? And you could, talk through some potential issues or just understanding the process is the whole goal here. And feel free to ask questions as the demonstration goes on. Okay, continue. Next, here we go. So these are the steps that I've come up with. First step is client contact. That's when when I get contacted by either you or the client themselves. And that's typically what starts the process. It's best done with a phone call, a text message, an email, some sort of correspondence that way that gives each other our contact information. I then reach out to the client and have a phone call with them, figure out what they do for work, figure out how they make their money, what they have saved, what their credit score likely is, uncover some potential issues. And I ask them for their documentation, tax returns, pay stubs, etc. I dive into all of these in the PowerPoint. So don't feel like you need to write anything down here. I dive into each of these steps as we go throughout this. But I get their docs, I work up their pre-approval, make sure that they qualify. I get you a pre-approval letter, you submit an offer with that, you get it accepted. We go through the transaction, we do the transaction, we do an appraisal, they get looked at and underwritten by the bank. Once they're done with that, we close. So it's a 6-step process in my opinion. Client contact. Again, I'm diving into all of those steps here throughout the PowerPoint. Client contact, again, is best done phone call, to be honest. If you come across a client that says, hey, I need to get a loan. I am looking to buy a house. I don't have all cash. I need a loan to buy this house. That's where you input potentially my name and says, hey, this is Alex. He works at our office down in Long Beach, and he works with a lot of the agents down there. He'd love to reach out to you, or feel free to reach out to him. Here's his phone number. Here's his email. And we start there. The whole phone call, the whole first contact with the client is what I like to refer as an info grab or a fact-finding phone call or connection. I like to talk to them about what they do for work, how much money they have saved, what their credit score is, if they've ever owned a house before. These are good questions for you to ask as well, just to know a little bit about your client, but that's really what I'm doing. I'm getting as much info as quickly as I can from them to determine what they can potentially qualify for, what I need to ask them to review, what the bank will potentially ask them to review, and then to figure out step number 3 on this, what documentation I need to get from them. I also have them use a link to fill out a loan application. What docs are needed? A lot of times you guys will get asked by your clients, well, do I have to give these guys everything I have? I've heard horror stories about all the documentation that's required. It's gotten better. It definitely has gotten better over the last couple of years. We're not as strict and we're not as intrusive as we used to be as far as the documentation and question standpoint from the banks, but typically it's tax returns, pay stubs, W-2s, bank statements, a copy of their driver's license or an ID, and then any docs related to any homes that they may own. Bank statements are obviously needed to prove that you have the down payment, and W-2s show their income. Tax returns, mostly tax returns are for self-employed people, but this is something that you could then tell your client, hey, this is what you would expect to have to deliver to the lender if you want to get a pre-approval. If any of these become an issue with your client, that they might have an issue getting a loan, and that might be something that you want to address before you go and show them 10 homes or 12 homes and drive around all weekend showing them homes. Here's that link to that loan application. The loan application it's a pretty seamless 5-10 minutes on my website. They fill in all of their information, social security number, address, employment. And what I do there is once I have that, I put it into my own system. I'm able to run their credit and see where they stand. And the loan application just gives me a really good detailed breakdown of the information that I'll need, that the bank will need to underwrite the client. This again is a link. It's really pretty easy on the website. You guys can go and check it out. I'll shoot out this PowerPoint after we are done with this. But maybe go through it. If you intend to have your clients use the website, go through the loan application and take a look at it. It's really easy. The website does offer people the ability to upload securely their documentation, which is always a huge question right now with security of documents. So you can make sure you mention that as well. Review it, pull their credit. I'm going to show you what I do as far as a loan option review is concerned, and then I get you the pre-approval letter. I typically give it to the agent in both a PDF form and a Word document form, so that if you need to edit the purchase price, or you need to edit the address, or you need to edit the date, you have access to that. I just ask that you always send it over to the listing side as a PDF so that no one else has the ability to edit it. Here's an example. I know it's a lot of numbers that are in front of you, but here's an example of what I do with the client to show them their payment options as well as their closing cost options. And this is really helpful, I've found, for people buying their first house or even people buying their second house, to have a snapshot before they even start looking at houses on what the payment will look like and then what the out-of-pocket costs will look like. The top section of my spreadsheet is the payment. I do 3 different rate options to show them, hey, you can get a little bit lower rate, but it's more expensive to get. Or you can take a higher rate, have a higher payment, but have less out of pocket. Each person's goals are different, and this addresses them. This allows me to go through a lot of the vocabulary with the client: loan amount, down payment, loan to value ratios, mortgage insurance, what an impound account is, what a HOA payment is, what title and escrow charges are. I have seller credit as an option down in the below. This really gives them a good initial breakdown of what the transaction, what the closing statement will look like. I've taken a closing statement for a transaction and I've broken it. I've definitely reduced the amount of line items there are on the closing statement, if you've seen those. But I try to give them an idea of what to expect at the end, because I found that the surprise of an extra $10,000 due at closing when people think they just have to bring their down payment to close a house is not a way we want to do business. So this allows them to understand that there are closing costs on top of your down payment. That's what I'm showing here. Okay. I give this to almost every client. If someone's just ready to go and they don't really care about the payment, they know that they have to bring in closing costs, I don't necessarily do this for them. But if it's someone that we're doing a pre-approval for, I even send this to them in Excel, and then it allows them to manipulate different purchase prices up on the top here where it says 825. they can plug in 800 and it auto populates the rest of the spreadsheet. So it then lets them know, hey, for $25,000 less, my payment goes down $100 a month. That's nice. I want to cap my search at 800, not 825. Or I could afford an extra 50 grand of purchase price because I can afford $4,000 a month. And this allows them to do that. And it also allows you on a weekend, or allows them to plug this in, and you don't have to wait for me to get back to you or try to find some mortgage calculator online that's going to give you incorrect information. There are obviously questions on this. There are a plethora of loan options. I do different PowerPoints on those different loan options. This is a conventional loan with 15% down using mortgage insurance. This is a pretty typical loan at this point in our purchase price realm. So that's why I decided to include it. But anyhow, there's, I make spreadsheets for interest-only loans and FHA loans and VA loans and 10% down and 5% down. And I do it all catered to the client themselves. Okay. An offer leads to an accepted offer. While making offers, keep me posted. I put that in there because a lot of the times, if you're a listing agent, you pick up the phone and you call the loan officer. If I'm not privy to the fact that you've written an offer using my pre-approval letter, I don't know that you've made an offer. So I have to just kind of pull it out of my back pocket. Oh yeah, I knew that. So we're a team. Keeping me posted, even with just a text message, or blind copying me on the emails over for the offer, or doing something that just keeps me posted. I'm always on my email, on my phone, so I'm aware. You don't have to call me and tell me, but if you copy me on the email or again text me, it just keeps me posted, and I'm able to reference it really quickly. So it seems like we're all in cahoots. I speak to listing agents. One of the things that a lot of the buyer's agents do in our office down here at Coastal is they say, hey, here's the contact for the listing agent on the offer that we just wrote. Can you please call them and talk to our specific qualifications? Tell them how qualified our clients are. Give them the rundown. Tell them we're going to close on time. As silly as it seems, people on the listing side love to hear this. It really makes a difference. So utilize that, whether you're using me or our other lenders in our other offices. Make sure that we call over to make our offer stand out. Okay, let's say that works to an escrow, an opened transaction. Escrow is opened. Next steps are, I have the loan submitted. I'm up to date on all the client's documentation. We order the appraisal right away. People always ask us, hey, how long do you wait to order the appraisal? Right now, appraisals are taking a long time. So appraisals are ordered at submission of the loan. And that's when the client would send their earnest money, EMD. One thing that you guys should always be aware of is to know where the earnest money is coming from. You typically have to submit your offers with proof of funds. But if all of a sudden the earnest money deposit is coming from overseas or coming from someone that we didn't know, it could potentially mess up our transaction. Escrow always likes to know where the earnest money is coming from as well. So, commit that to your steps of your process and knowing where your earnest money is coming from when you get your proof of funds from your client. One of the other things that we do typically right away, because the market is so volatile, is we lock in the interest rate. You lock it in for 30, 45, 60 days, however long your transaction is going to be. But it's important to note that if I'm locking the interest rate for 30 days, I need to know that that's a 30-day transaction. If, just for some reason, I didn't know that you wrote the offer for 45 or 60, or there was a, long escrow, definitely want to keep your loan officer informed on the timing of the transaction. Even though you write the offer, we're busy. I would like to say that I always review the offer and see how long you wrote the offer for, but definitely would be very helpful for us if you just said, hey, this is a 30-day or less transaction, or this is a 45-day. Keeping us informed would be helpful pertaining to the interest rate lock. What is underwriting? underwriting is a long process. It's a process that essentially starts on day one of the transaction and, you know, can go through day 25 or so of the 30-day transaction. In underwriting, the bank will take a look at the client's pay stubs, verify their income, verify their employment. They'll make sure that their bank statements have the money that they say they're going to use for the down payment and any sort of reserves that they would need. They take a review of the appraisal. Condos are very important in underwriting. They review the condo docs. They make sure that the condo is liquid enough, has enough reserves, is collecting enough HOA dues, doesn't have any litigation. Essentially, they do a pretty decent scrub of the client's financials as well as the property. And what you get after initial underwriting is called a conditional loan approval. What that means is, hey, we like the client, but we have these questions still. Where is this money coming from? What was this overtime that you did here? What was this little blemish on your credit report? A conditional loan approval is not a final loan approval. Conditional loan approvals are typically what get done, though, prior to the release of your loan contingency. It's very infrequent that a final loan approval is done before the 17 or 15 or whatever days you guys use right now for your loan contingency is up. So at the point that I see a conditional loan approval, I need to determine that there's no conditions that remain that would, you know, prevent me from giving my blessing to the client to release their interest money deposit hard. That's something that we would go over together. Don't ever release a loan contingency until you talk to the loan officer. Just because the listing side sends you the request, don't ever sign it. Make sure that you know that the loan is good to go, because that's putting your client in a bad place if you release their earnest money without talking to the lender and making sure the loan is good to go. Okay, we then reach back out to the client. We say, hey, client, your loan's approved, but I need to just ask you these few questions or get these few documents. And that leads to what's called a final loan approval. Final loan approval is what starts the closing process. That's when the bank says, hey, this thing's stamped, sealed, delivered, let's go. And they, start the closing process. I asked this question down below. Conditional loan approval is different from a pre-approval. It is. Typically, a conditional loan approval is when the underwriting that the bank has done their look. It's different than my pre-approval, which is a little bit more superficial than a conditional loan approval. There's different searches that the bank has on people that are a little bit more, they just dive a little bit deeper than we can on our pre-approvals into a client's name and history. And something that typically always comes up and is like, if a client has been divorced in the past and was neglected to tell us, and then the banks can search that through public records and they find out, and this client may be paid alimony or child support and they didn't tell us about that. That's typically one that would come up and be that creates an issue. So that's where a conditional loan approval might be different from my pre-approval. And we typically like to go as deep as we can on the pre-approval, but pre-approval doesn't mean your client is 100% guaranteed to get the loan. I'd like to say it is, but there are things that come up and we just have to deal with them as they come up. One of the things, the final loan approval the client definitely needs to do is have all the money arranged. We want and we strive to have them ready to send their final funds, probably 5 or so days before closing. They like to finalize their home insurance at that point as well. So, we're on top of it with your clients. We're making sure they're prepared so that we close on time. But there are a lot of steps that go into this. And that's what I'm demonstrating here. There's a lot of things that go into getting a loan from soup to nuts. And if you have any questions, please, let us know. Next, closing. One thing that's really important in closing is called the closing disclosure. Okay, the closing disclosure is a document that I'm sure you guys are aware of now, but it comes out from the bank, and it is a pretty good estimate of your payment, how your payment is broken down, as well as your closing costs. The closing disclosure needs to be signed, and then a 3-day waiting period persists after that before the client can sign the final loan documents with the notary and close. One thing that always gets asked, let's say for instance, your client signed the closing disclosure on Tuesday today. Tuesday counts. So it would be Tuesday, Wednesday, Thursday is your timeline. And then Friday, the client could sign their loan documents. In that time stretch right there from Tuesday to Thursday, my bank and I are working on sending the escrow company the loan docs. They send them the loan docs. The notary gives then informed that, hey, we have loan docs for this client. The notary will reach out to your client and either most likely go to them these days and sign the loan docs in person. It typically must be in person. I put options there with a question mark. One of the things that we can do if the client lives in Texas and we're trying to close a house in California is you can do a power of attorney. So keep that in mind. Or they can go to like a consulate or something. If they're out of the country, they can get things notarized there. But most of the time, the client and the notary need to be in person. Make sure your clients are around. They shouldn't be taking a vacation when they're buying a house, even though it happens. We have options, but try to get their 30-day schedule in front of you so that you know that they're around when you potentially need to sign the loan documents and send the final money. Just like the earnest money, have an idea where your client's final funds are going to come from. I'm obviously doing that, but if you have final funds that are coming from a mother that's across the country or a father or somewhere out of the country, that needs to be set up before day 30 of 30 on the transaction. Once the documents are signed, the bank reviews them. They make sure the signatures look like the person's signature, make sure that they signed everywhere. And once they do that, they send the wire. The bank sends the wire of the loan to the title company. Once the title company receives it, they let the escrow company know that they've received the wire from the bank. And as long as your client's funds are in there and everything's all signed up, the loan is funded. And then after that, that's when the loan is recorded and the title transfers and you guys get your deal closed. Go back. I didn't know that was my last slide. That's closing. That's loan is funded. That's soup to nuts. That's pre-approval. I call the client. I get their information. I get their documents. We get you a pre-approval letter. You find a house. We get the loan underwritten. We get the loan conditionally approved. We get the loan final approved. We send the CD, we send the loan documents, they sign the loan documents, they send their money, the bank sends the money, and voila, we have a deal. And you get paid, and everyone's happy. That is soup to nuts.
This is really amazing. Thank you so much. For us new agents, it's very helpful. My question is, how long is the process exactly as far as once the house has been, I guess it's just open escrow, once the offer has been accepted till the end? Is that a 2-week process?
I mean, you write it in your offer. So when you write your offer, you write close of escrow to be 30 days or less or on X date. That's essential. As silly as it seems, almost all the deals go from that day that you start to that day that you write on the offer. I don't know how it always works, but for some reason it always works that we're closing on the day that you said we're going to close, and we close on day 30 of 30. So if that's your question, it typically will take the amount of time that you write in there. We strive to do it quicker, but most of the time it takes right up to that point. Maybe 5 days or so less would be, ideally we like to get it done in 25 of 30, but yeah, it's normally 30-day transaction is a really common timeline, and it is what things are taking because the market is pretty saturated and pretty busy. Stuff is taking about 30 days.
Since what I'm seeing right now is a lot of my team members are writing 21 or 17-day loan contingencies. That's
Yeah,
tight.
that's a good question. That's a different question. So the loan contingency is 17 days is fine. The loan contingency is the amount of time that it'll take me to get the loan to a point that I feel comfortable telling you that your loan is good to go. And that's more than adequate. 17 days, 14 days, 10 starts to get really tight, but somewhere between 12 and 17 days would be ideal. If you really need to stress on that to get your offer accepted, I would say 12, 14 is okay on the loan contingency. The loan won't fund at the end of that loan contingency, but it'll be at a place where I can give you my thumbs up and my blessing and say, hey, you guys, yeah, we're good to get this loan.
Yeah, thanks for the clarification, because I wasn't sure if it was funding involved or not. So it's not the funding involved, it's just a thumbs up that all is good.
Exactly, just the thumbs up that all is good. Another question you might be curious of is how long that pre-approval process takes. And that depends on how long it just takes the client to send in their documents. But typically when a client sends their documents to me, I can turn it around in a couple days. If they have a property that they're completely interested in and you tell me that, I can do it quicker. But if it's just a generic pre-approval, it takes me a couple days to analyze their tax returns, their bank statements, their pay stubs, and then get you what their numbers are. It takes me a day or so to go over that spreadsheet with them and help them understand what a loan entails and looks like. But yeah, it doesn't take me 2 weeks to pre-approve a client. A pre-approval is typically good for as long as your client keeps their job and pays their bills on time, is how I like to phrase that. I'm not typically taking people to their max qualifications. So a slight fluctuation in interest rates isn't going to unpre-approve a client for me. So
about 6 months, or just you said as long as they keep their job. So
yeah, I mean, if we're shopping for homes and we're 6 months out from when I initially looked at things, we would obviously like to get some updates and make sure that nothing's changed. I mean, I'm not giving someone a pre-approval letter and then reaching back out to them in 6 months and checking in. I'm persistently checking in every week or 2 weeks and saying, hey, you found any homes? And I'm offering them an opportunity to update me on their financial situation in that case. But pre-approval letter can last 6 months. It can last a year if it takes that long, as again, the client is, continuing to keep their credit score up and pay their bills on time and, keep their job. If they change their job, that's fine as well, as long as it's in the same industry. I mean, I have a deal where the client is getting a new job as we're in escrow, and I could just use the new contract, a new pay stub from that new job, and I'm fine. So it's not an ideal. It's not something that you recommend a client to go look for a new job while they're buying a house, but it doesn't put the, bosh on the deal. It still keeps the deal going as long as it's not, W-2 employee to a self-employed person. That would be where we would have issues. But if it's just someone working at Amazon and going to work at Google instead, you're fine.
Right. I have a client at the moment who is really wanting to put the very small down payment, and he wants to do an FHA. And I said, go ahead and talk to the lender and see if he's going to give you details about that. I mean, I don't know if we can get into that as agents.
I mean, I don't, that's a broker question. To be honest, I typically find that if someone has decent credit score and 3% or 5% down, a conventional loan is a much better loan. It creates less issues from an appraisal standpoint. It creates less issues. FHA loans are in the market for a reason, though. There are people that need an FHA loan if their credit score is 620-ish, if they only have 3.5% down, if their debt to income ratio is high, they need to use an FHA loan. So they're there for a reason. I personally, from my lending standpoint, like to give them both options. I build those spreadsheets and I give them what an FHA payment looks like and what a conventional loan payment looks like, and explain to them the differences. I find that if I was doing a loan for my friend or a colleague, I would recommend a conventional loan over an FHA loan, but there's definitely a place for both loans in the market and a reason to use both. The FHA loan just gets a lot more press, and it's why a lot of people come to you and say, hey, I just want to use an FHA loan. But they're not the best loan if the client has a good credit score and a good job and some access to some down payment. There are better loans for them. And I explain both of that to them.
As far as the rates go, is FHA a better rate, or there's?
FHA is a lower rate, but the mortgage insurance is twice the amount and it stays on the loan for the life of the loan.
Oh, I see.
So ultimately the payment, the overall payment is higher. And it takes some time to explain to a client, you know, why a rate of 3% is better than a rate of 2.25%. But I do, and I'm able to show them why this is a better loan, and they should be buying the payment, not the rate. You know, we have to always strive to get people unfocused on interest rates and more focused on their monthly payment. That is what they're paying every month, not the interest rate.
And as far as the property is concerned, some properties do not accept FHA loans, or it doesn't matter?
FHA appraisers are more strict. So if a property is dilapidated, the FHA won't give it a loan because they're not putting very much skin in the game, right? An FHA loan is only 3.5% down, and typically the clients are more risky from a financial standpoint. So the bank wants to assure that the house isn't going to fall down.
Right. Okay.
That's why that's why the appraisers are a little bit more strict. You know, these days, the conventional loan and the FHA loan, I think, you know, there isn't very often where a house would qualify for a conventional loan and not qualify for an FHA loan. The FHA loan just has a little bit tighter restrictions on chipped paint and termite issues, but they aren't very different. And that's kind of a misnomer in the market, that the FHA loan, if I accept it, all of a sudden I'm going to have to do a gazillion dollars of home repairs for this client. That's not true.
Sounds good. Thank you so much. This is excellent information.
Sure. The last slide is just what rates are today.
Yeah.
So take a look. Conventional loans. This needs to be updated. I apologize. The conventional loan limit is now 625. So this right here where it says conventional loans, 548,250. It's very important. It's now $625,000. This one, conventional loans in LA can now go up to $937,000. Okay, very important. It just changed. Some banks are doing loans there, some banks are not. It should be in full effect in November. But why is that important? Conventional loans let you do purchases with 5% down. Jumbo loans are typically 10% down. So now a client can buy a $950,000 house with 5% down, whereas they used to only be able to buy an $850,000 house with 5% down. So it really increases their purchase power with these increasing home prices. You'll see that jumbo loans are, still decently priced in the low threes. 15-year loans are very low, 2.25%, higher payments though. FHA loans and VA loans have the lowest interest rates. FHA loans, as we've talked, Suzanne, have high mortgage insurance though. So because their rates are low, they counterbalance that high mortgage insurance amount with the lower interest rates to help people qualify. And it's a government-backed loan, so it's, the banks are getting, the assurance that the government will pay them if the client doesn't pay and default on the loan. The VA loans are the best loans in the business. They are the lowest interest rates with no mortgage insurance, always down in the low twos these days. Yeah.
What did you say again is the 822 went up to 937?
937, yeah.
And the 548,250 went up to 600, what again?
625.
Okay, 625K. Thank you.
Sure.
And that's November 1st?
Banks are starting to do them now, but it'll be full, like all the banks will probably input that as of in November. The Federal Housing Administration, the FHFA, has come out and said we're going to raise these and banks are striving to get more business because everyone's already refinanced and they've saturated themselves with employees. So they need to figure out how to get more business. And they're taking on these loans before the Federal Housing Administration, the FHFA, I believe is what the acronym is, has actually said, hey, we're good to go. But they will. And it's again, 625 and 937.
Just Carr came up with some new interest rates. Are these the latest ones? There's some increase on the rates. Is that?
Rates gone up. Yeah, rates went up. Rates went up probably 2 weeks ago. These are still pretty solid though. Our model is that of a broker, so our overhead is low and we're able to keep our rates low.
That's good.
Yeah.
These are
And
great.
this is,
Not
I mean, this requires high credit scores. This requires significant down payment. I should have a little disclaimer in this one, so don't send this off. But this is with 40% down. This is with 740 plus credit score. This is not, but a loan with 5% down on a 625 loan amount is 2.875. It's not 4% today, right? I'm not that far off. The payment difference is $30. So these are you could just always use roughlies and shoulds and woulds instead of absolutes when you talk about rates. That's what I found.
Did you say that 4% or not 4%?
Not 4%.
So they are closer to 2.8%.
Yes.
That's
Yes.
not bad.
Yes.
They were 4% about 3 months ago. FHS.
No, FHA is always, ever since like 2019, FHA has always been above. Yeah.
Welcome to your wrong language.
Here's some contact. It should come up. All right. Email, phone.
I was going to ask you that next. So there you go.
One step ahead of you.
Thank you.
You're very welcome. That's all we got. Do you have any questions?
I don't think so. Does anybody else out there have any questions for Alex?
One question I have is I have a client that I just met and I want to kind of get her into buying. And she said that last year she didn't file her taxes. So she said this year, I don't know what she means by this year. It's already end of the year. So what does that mean if they say like this year I'm going to file my taxes? And I recommended her to speak to a lender before even she files her taxes, so you guys can guide her accordingly what to write in order to qualify for a loan.
I mean, there's certain income levels that don't require you to file tax returns. But
really?
maybe she just, people don't file their taxes and then they have to pay penalties. 2019 taxes were due, October 15th. I think they extended that because of COVID in 2020. Now 2020 tax returns were just due 4 days ago. So in my case, if someone doesn't file their taxes, there are potential loans that we can do. Typically what the banks do is they order a tax transcript. It's a document that the client signs called 4506. And that allows the bank to confirm that the tax returns that are filed with the IRS are the same as the tax returns that I've presented them. There are a lot of deals that I do these days that don't require tax returns. So if the client's W-2 and just a salary style job, the banks typically will not even ask for tax returns. So there's ways around it, but I mean, you can't have your cake and eat it too. A client needs to file their taxes. They should be on the up and up. I don't want to be, doing fuzzy loans, manipulating it. I just, they should be filing their taxes. It's not a prerequisite that I actually see them and do them, but we definitely want to tell them to file their taxes.
Well, what she said was last year our income was very low. We're thinking to do the taxes, then we apply. So I don't know. I mean, I kind of want to push her to speak to a lender so you guys can kind of guide her and help us out. But I mean, at this point, I guess she has to do that work. She's got the taxes going before she even applies.
Yeah, I mean, that's the issue with my job is each person's background and finances are different. My finances are different than yours, Suzanne. So that's what makes our job pretty difficult is that we have to analyze each person individually. I can give her some advice. A CPA would probably be a better resource at that point versus me.
Yeah.
But I can tell her what she can potentially do and what my guidance would be on her situation. If she's just a pay stub employee now and collects, a salary and a W-2, it's viable that she would have needed to file her tax returns.
Yeah. Yeah. So I'll have her talk to you guys, and that's where to start. Thank you.
Anybody else? Question? Oh, here we go.
Yeah, so when they have to file taxes will be when their income varied too much, like in 2020, this particular guy's income was mostly from unemployment. But they were paying him well. So
You can't use unemployment now. It's not going to continue to get it.
So repeat the question so they can.
She just asked me if someone can use unemployment income for a loan. I mean, technically, if you have continuance of it, which is the opposite of what unemployment income works like, you could use it. Disability income is one that we get to use because you have a proof that it's going to persist in the future. Unemployment income, they like to look at it and see that you were collecting it and establishes a work history for you, right? It's like, hey, I was working, I was unemployed, I was collecting unemployment income, now I'm back to work. I can use the income from back to work because there was the gap. If they're collecting unemployment income, it kind of fills in the blanks for me. So it's a good thing. But to try to say, hey, this client made a ton of money on unemployment, you should give them a loan is not how it works.
they have to be back to work and making the same or more.
Back to work on a salary or W-2 style job. You can't be back to work doing self-employed business. It can't be a realtor collecting unemployment and then coming back to work as a realtor and just saying, hey, I'm now back to work. It has to be a pay stub style job. Every 2 weeks you get paid X amount of money.
Right.
That's what we would need for someone coming off unemployment.
So will you need them to do their taxes to show from 2019, for example, what kind of income do you use? What kind of taxes or W-2?
Not necessarily. No. We go off of, essentially it's a pay stub, it's W-2s, and then they call the company that the client works for and verify their employment. Say, hey, did these guys have their job? And that's what we would go off of. It's rare that tax returns actually come into play for a salaried employee at the moment.
Yeah, because in 2020, they won't have W-2.
Then that's where they would have a 1099 from the unemployment. I would use that 1099. And then they would have a pay stub from their job in 2021. And they would use the income from the job in 2021.
So they won't have 1099 either because they are W-2 income.
You said they wouldn't have a W-2 in 2020.
Correct, because they were on unemployment for the most part.
Right. So what I said was that in unemployment time, they would have a 1099.
They could use the 1099.
You just use that for the work history.
Right.
Say, hey, I was working, I got fired, or I got laid off, but I was collecting unemployment. Now I'm back to work.
Right.
Because they're now back to work.
They will have pay stubs.
We like to. I would say, in the future, you should tell them that they need to be back to work for 6 months before they can get a loan.
Okay.
Yeah. That would be my recommendation. 6 months
see.
back to work after unemployment. Yeah. And not with a family. It needs to be a job that's not run by a family.
Okay. Thank you for that. So the one last question.
Okay.
The 5% down.
Yes.
It has PMI too, right?
Yes.
For the conventional.
just repeat for the audience.
She just asked if 5% down has PMI for a conventional loan. Typically anything less than 20% down on conventional has PMI. There's two ways to structure PMI. There's lender paid PMI and borrower paid PMI. The borrower paid PMI is the common one that people know about. That's where you actually see, I'll go back to the slide.
And PMI for the new agents, can you just?
PMI stands for private mortgage insurance. So anytime you don't put down 20%, the bank's risk is higher, and they require you to have additional insurance of the loan that you won't default. In this instance, right here on this loan that I'm presenting to you guys, the private mortgage insurance is that $76 number in the middle. Okay, this client is buying an $825,000 house. They're putting down 15%, not 5, but they're putting down 15%. If, for instance, they were only putting down 5%, the monthly mortgage insurance premium, that number there in the top middle section, MI premium, would just be higher. Okay, it's just more insurance to put down less money, but it's not much. I mean, it doesn't go to $500. It goes to like $175 or $200 a month to put down less money. So cash is, in my experience, cash is always more important than a slight incremental increase in your monthly payment. People can stomach $200 a month much easier than they can stomach an extra 100 grand or an extra 75 grand of down payment. So I have subscribed to put less down and use your money to fix your kitchen or fix your bathroom or keep a rainy day fund, unless we're really, really tight on their income. But I think the mortgage insurance actually serves a really good purpose in the market in letting people get into homes with less down payment. And it's not that they're not that expensive monthly. So
Alex, you mentioned verification of employment.
Yeah.
That occurs right before closing,
Yes.
correct?
Yeah.
Because I once worked with a buyer who was getting out of the military but didn't have a job lined up. She qualified while in the military. They do a verification of employment and the lender finds out she doesn't have a job, she couldn't move forward.
Correct.
She had never shared that with me until a couple of days before closing. But I just want to make sure these new agents realize that that is something that occurs close to closing versus just on the forefront.
Yeah. So here, let me see if I said it. I think on this one, final loan approval, all income, asset appraisal, condo, employment questions cleared. Literally the last step of a loan is before the bank sends the loan docs, they call the companies to make sure your client still has their job. Some companies use a third party, like one is called the work number, for instance, to verify the client's still working. But very important that your client doesn't resign from their job the day or two before they close. And as silly as that sounds, it happens. Obviously, it happened to Deb. So, when you create your checklist, that's the whole goal of this presentation, is to create your checklist. You need to be versed in loans just as much as you're versed in property values. This is such an important part of your business. So create your little checklist to say, hey, where's your down payment coming from? Is it set up where you're still going to have your job on day 30 of 30, right? Your mom isn't sending you money for this, or if they are, is that all ironed out? There's certain little idiosyncrasies of these loans that you can just cross off, and it's going to make you way better at your job and prevent way more deals from blowing up at the 11th hour. That's the big fear, is that you're already counting your chickens and they haven't hatched yet, so
Not a happy moment.
don't
Not a happy moment.
don't let that happen, and do your diligence here and call me, let me know if you have questions on some of the steps. I got to cut out right now, Deb. Sorry, I got to be
No,
somewhere.
that's okay. That's fine. Do we
But-
have your information?
Yeah, it's
screen?
on
You
the
can put
it's
that
on
up
the
there
last
right now?
side.
You put that
Thank
up?
you so much. This is amazing, Alex.
You're very
Yeah,
welcome.
thank you all for joining us today. We appreciate it. Alex, as always, great information, and these guys do appreciate you being here and sharing yourself.
Thank you.
leave that up for a moment or
Oh.
two, so everybody has a chance to copy it. I'll put it in. Oh,
Sorry,
did you do that?
to
I actually forgot to talk about the
There.
lender page.
There we go. Okay, I'll bring it
the
in.
lender pay PMI,
Yeah.
it's just a higher rate.
Oh,
Yeah, they take a higher rate to finance the PMI.
oh,
It's not
like
advantageous.
about 30%, no.